StubHub, you know the name. If you've ever desperately tried to get into a sold-out concert or a huge game, chances are you've landed on their site. Well, now the ticketing giant is getting ready to go public. So in this explainer, we're going to rip open their official S-1 filing and give you the inside scoop on what every potential investor really needs to know.
You know, every great company starts with a problem. And this quote, which is straight from their official filing, tells you everything. It's 1999. The founder, Eric Baker, just wants to see The Lion King, but it's sold out. He realizes there's just no safe, trustworthy way to buy tickets from someone else online. That single moment of frustration, that was the spark that created this entire business. All right, so here's our game plan. First, we'll get into how the business actually works. Then, we'll look at the bull case, all the reasons to get excited, and follow that right up with the bear case, the big risks. We'll crunch the key financial numbers, figure out who's really calling the shots at the company, and then wrap it all up to help you frame the big decision. Is this an IPO worth getting a ticket for?
Okay, first things first. Let's get down to the basics. What exactly is StubHub's business model, and more importantly, how do they make their money? Before we dive any deeper, there's one term you absolutely have to know: gross merchandise volume, or GMV. This is the single most important metric for a marketplace like this. It's the total cash value of every single ticket sold on the platform. Now, this isn't their revenue, but it tells you the sheer size of their operation. Keep that GMV number in your head. The model itself is actually beautiful in its simplicity. Someone has a ticket to sell, someone else wants to buy it. StubHub jumps in the middle. They act as this trusted go-between, making sure the ticket is legit and the money changes hands safely. And for playing that role, they take a percentage cut from both the buyer and the seller. That double dip on the fees is what powers their whole revenue engine. All right, so now let's talk about the good stuff. What are the big, compelling arguments for being bullish on StubHub's future as a public company? Let's build that case. Well, for starters, the potential market is just gigantic. I mean, look at that number. The company's own filing points to a global sports tourism market that's expected to hit $1.3 trillion. This isn't just about going to see your local team anymore. People are flying across the world for big events, and StubHub wants to be the main platform for that entire experience economy. Now, this is where it gets really interesting. This chart isn't about the resale market. It's about the primary market, where tickets are sold for the first time. And as you can see, it's super fragmented. No one company has a stranglehold on it. This is a huge opportunity for StubHub. They're pushing into what they call direct issuance, partnering directly with teams and venues to be the first seller of the ticket, not just the reseller. That's a massive new playground for them. So how do they protect their turf? Well, the company argues it has 4 big moats, or competitive advantages. They've got the tech platform, a global reach, a brand that people trust, and, here's the kicker, a treasure trove of data from over 450 million tickets sold. That data creates this powerful flywheel effect. More sales means more data, which helps them get smarter about pricing, which attracts more buyers and sellers, and the wheel just keeps spinning faster. But it's not all standing ovations and encores. Every investment has a dark side. And by law, companies have to spell out their risks. So let's flip the coin and look at the bear case, pulled straight from their own warnings. So what are the things that could potentially bring the whole show to a halt? The S-1 filing is pretty blunt about the top risks. I mean, obviously, their business relies on live events actually happening. The competition is absolutely brutal. And then you get to the really juicy stuff, the financial red flags. They've struggled to be consistently profitable, they're carrying a ton of debt, and, this one's a big one, they admit to material weaknesses in their own financial controls. And I really want you to see this in their own words. The term material weakness is serious Wall Street jargon. It's basically the company saying, hey, just so you know, our internal systems for making sure our financial numbers are accurate have some pretty significant problems. For any company about to go public, that is a massive red flag that should make any investor pause. Okay, enough with the hypotheticals. Let's put some cold, hard numbers behind both the bull and the bear arguments. Let's take a look at how the company's actually been performing. And right here, this is the heart of the bull case. Just look at that GMV growth. It's a rocket ship, from $4.8 billion in 2022 to a projected $8.7 billion in 2024. The total value of tickets flowing through their system is just soaring. This is the kind of top-line growth story that gets investors really excited. And this is a big but, that growth isn't the whole story. As revenue goes up, take a look at the bottom line, their net income. It's a total roller coaster. from a $261 million loss to a $405 million profit, and then right back to a loss. This perfectly illustrates that bear case concern, turning all that impressive sales volume into consistent, predictable profit. Yeah, that's been a real struggle for them.
And we just can't gloss over this number. Nearly 2.4 times billion dollars in debt. That is a heavy, heavy backpack to be carrying. A huge chunk of their cash flow has to go to just paying the interest on that debt. And that's money that can't be spent on marketing, technology, or growing the business.
Okay, there is one last super critical piece of this puzzle that every investor needs to understand, and it's all about power. Who is actually going to be in the driver's seat after this company goes public? StubHub is going public with what's called a dual-class stock structure. Here's how it works. You, the public investor, you buy Class A shares. You get 1 vote per share. Simple enough. But the founder, Eric Baker, he holds Class B shares. And those get 100 votes per share. You don't need a calculator to see what that means. Even after the IPO, he maintains absolute voting control. So when you invest, you're not just betting on the company, you're betting on him.
All right, let's wrap this all up. We've looked at the business, the good, the bad, the numbers, and the power structure. So, what's the fundamental choice here for an investor?
It really comes down to this classic investor's dilemma. On one hand, you have the clear market leader in a massive, growing industry. They have a powerful brand and that incredible data flywheel we talked about. But on the other hand, you have profits that are all over the map, a mountain of debt, fierce competition, and, let's not forget, the company's own admission about major weaknesses in its financial reporting.
So, that leaves you with the final question to ask yourself. Is StubHub's dominant position in a booming market a ticket to incredible growth? Or are the shaky financials, the huge debt load, and the founder's iron grip just too high a price of admission? We've laid out the facts from the filing. Now the decision is all yours.